Hi, my name's Eric. I'll be reading you Barron's Magazine with an issue date of June 15th of 2026. This reading is produced by the Audible Local Ledger, a reading service exclusively for people who are blind or print disabled. We'll start with Up and Down Wall Street, Wall Street's Best Kept Secret Partnership by Andy Serwer. Business partnerships can try men's souls, never mind the wallets of those who invest in them. So far, though, the tie-up between super investors Bruce Flatt, CEO of Brookfield, and Howard Marks, co-chairman of Oaktree Capital Management, seems to be mostly friction-free and fruitful. 7 years ago, Brookfield, the giant alternative asset investment company, bought 62% of distressed debt investment firm Oaktree for $4.8 billion, and Marks and Flatt have been joined at the hip ever since. Now, Brookfield is buying the piece of Oaktree it doesn't own for some $3 billion. As with many productive partnerships, Flatt and Marks, which sounds like a bluegrass band mashed up with a high-end British retailer, are complementary cats. Flatt, who's 61, was Manitoba raised in Winnipeg and is a University of Winnipeg graduate whose parents worked at a local mutual fund company, Investors Group, that his father co-founded. Marks, who's 80, a legendary market commentator and Brookfield director, is a New Yorker, Forest Hills High School in Queens, with an undergrad degree from Wharton and an MBA from the University of Chicago. Both are far from flashy and possess stellar investment bona fides. I recently wrote about identifying the next Warren Buffett and picked Flatt for his asset allocation acumen, pointing to Brookfield's 19% annualized total return to shareholders over the past 30 years. And I tapped Marks for his market analysis and wisdom dispensing. Here's a timely one. Prices are too high is far from synonymous with the next move will be downward. Things can be overpriced and stay that way for a long time, or become far more so. I sat down with them to ask about working together in all things markets. How's the marriage going? Extremely well, Mark says. Brookfield is not a control freak, and in particular has not inserted itself in our investment process. They've given us additional resources that help us do a better job. As for markets, it's fair to say that Marks is sounding an alarm without trying to sound alarmist. There's no arguing that for the most part, since October the 1st of 2022, which is when the Fed turned more dovish, optimism has been in the ascendancy, he says. The stock market has more than doubled over that period. Optimism is what permits things like the SpaceX, Anthropic, and OpenAI IPOs. You can't have that in a pessimistic environment, so you have to recognize the ascendancy of optimism. Part of that means some part of your body has to be saying, how do we prepare for less optimistic times? There's a bifurcated market, says Flatt. If companies are technology related, that's one multiple. But there's a lot of low multiple cash flowing businesses that people have forgotten about. These big IPOs are the antithesis of it. Brookfield, which has investments in 2,000 plus companies globally that operate data centers, hydroelectric plants, transmission lines, cell towers, ports, toll roads, and more, has a complicated past and present. Brookfield is based in Toronto. Canadian Prime Minister Mark Carney was chairman of its asset management business before assuming his current role last year. And its origin story begins in 1899 with a Canadian-owned Brazilian power company named Brascan, which in 1997 merged with a complex investment firm called Edper, set up in the 1950s by a branch of the Bronfman family. The resulting company became Edper Brascan, which a wise soul shortened to Brascan in 2000. In 2002, Flatt became CEO, and even more wisely, changed the name in 2005 to Brookfield. For decades, predecessor companies of Brookfield had been buying, selling, and investing in businesses, which differentiates it from the likes of Blackstone and KKR, which began solely as investment vehicles. Flat has expanded its capital raising as well. Here's what Brookfield looks like today. On the top sits holding company Brookfield, ticker BN. Its main asset is a 74% stake in Brookfield Asset Management, BAM, a $75 billion market cap, publicly traded, pure-play asset manager. BN's second bucket is a collection of listed operating companies, a 45% stake in a renewable energy holding company, BEP, 26% of an infrastructure company, BIP, 69% of a private equity company, BBUC, and 100% of a massive real estate business, some 700 million square feet of commercial space with trophies like Brookfield Place in New York City and Canary Wharf in London, and pieces of venerable real estate companies like General Growth Properties, Rouse, Olympia, and York, and Howard Hughes. Like Apollo Global Management and KKR, Brookfield has an insurance business, its third leg. With $200 billion in assets, that provides the parent with cash from its float. Insurance has been a listed company, BNT, but Brookfield recently announced that it will combine BNT into BN so that insurance operations will have direct access to Brookfield's balance sheet, allowing it to expand more readily. Fee income from all three units, $5.4 billion last year, provides steady cash flow to Brookfield. Complexity has its privileges. Brookfield is now the biggest holding of Bill Ackman's Pershing Square hedge fund, owning almost 59.7 million shares at the end of March, worth $2.7 billion. In his 2024 annual report, Ackman wrote, "We believed BN's stock was extremely undervalued. Our acquisition at this valuation was made possible in part due to the complexity of BN's holding company structure." Morgan Stanley analyst Michael Cyprys, who has a $60 price target on the stock, writes, "BN remains focused on capital compounding, disciplined underwriting, and value realization, rather than macro forecasting or asset gathering for its own sake." Oaktree was founded in 1995 when Marx and his partners left the trust company of the West to set up their own firm to invest in distressed debt. Oaktree was publicly traded from 2012 to 2019, but its stock performance was so-so, generating a total return of 93.7% versus 149.4% for the S&P 500, reflecting perhaps the cyclicality of its business during a stock run-up. With public ownership, if you can't produce a steady stream of assets and growth, it's not an interesting story, Marx told the Wall Street Journal. Given truth serum, says a person familiar with the company, we would have said, on our own, we're not keen to be a public company. Now Oaktree is immersed in Brookfield's ecosystem, which includes massive bets on electrification and power generation. Is there a bubble there? The expectation in what people need is here, Flat said, gesturing high with one hand, and what the world is building is here, gesturing low with the other hand. It's dramatically different because this is hard to do. You have to have the site, the power, and connect the plant or the grid. You need to build the facility. You need to put chips inside of it. You have to have between $20 billion and $250 billion. What about credit? Lifeblood of the alts business. The credit markets have been on a tear for most of the last 17 years, says Marx. Fear recedes, skepticism and due diligence decline, and eagerness takes over, along with fear of missing out. If I don't cut the price of this loan, my competitor will make the loan. What should Fed Chair Kevin Warsh do? I would never tell Kevin or any Fed chair what to do, Marx says, but I would start by taking the negative. I don't see any reason to cut rates. I don't think this economy needs stimulus. We certainly don't want to make it easy for inflation to rekindle, so I guess there are reasons to raise and not to cut. Brookfield, with a $100 billion market cap, is now the second largest alt asset manager after Blackstone. and its stock performance is better over the past 3 years. During periods when people are worried about markets or alternative managers, our businesses, because of the durability of our cash flow streams, are seen as a much safer investment, says Flatt. Brookfield has relatively limited exposure to private credit software lending, less than $10 billion out of some $1 trillion in total assets under management, a spokesperson says, some of which is publicly traded. $1 billion in AUM, business development company, Oaktree Specialty Lending, which has fallen from $23.43 in early 2022 to $12 today. How do Flatt and Marks work together? With $1.2 trillion of total assets around the world, neither he nor I make any real decisions, says Flatt. We care about the culture of the organization, how we're investing, the ethos of how we invest. Howard and I spend a lot of time talking about those things, which are extremely important from an overall perspective of an organization. Investments aren't about getting rich overnight. They're about compounding wealth over very long periods. Does Marx spring his aphorisms on Flatt during their meetings? Daily, deadpans Flatt. A quick note about companies named Oak in the investing business. There are a number of them, some related, some not. Given the physical properties of the genus Quercus, to which oak trees, the king of the forest, belong, density of wood, longevity, a prodigious supporter of other species, it's not surprising so many firms choose oak. There's Marks Oaktree Capital Management and 2 oaks that sprouted from Acadia, a partnership that began with backing from the family office of Robert Bass, one of the billionaire Bass brothers of Texas. The firm was named Acadia after the national park near Bass's home on Mount Desert Island, Maine. In 1991, Bass changed the leadership of the firm, promoting Glenn August and Dan Doctoroff, later CEO of Bloomberg, and others to run it. Consulting an atlas to find a fitting name adjacent to Acadia, they landed on Oak Hill, a modest rise on Mount Desert Island, and renamed the firm Oak Hill Capital Partners. In 1999, August split off the credit business from Oak Hill and named it Oak Hill Advisors, or OHA, which has $112 billion in AUM and is now owned by T. Rowe Price. Oak Hill Capital Partners continued in the middle market private equity business, where it's a significant player today. Unrelated to either of these is Oak Investment Partners, or OIP, a venture capital firm founded in the late 1970s. Oak HC/FT, healthcare fintech, with $7 billion in AUM, is co-run by VC vets Andrew Adams and Annie Lamont, wife of Connecticut Governor Ned Lamont, who worked at OIP. I guess it's like what Tony Orlando and Don said. Tie a ribbon round the old oak tree, August tells me with a chuckle. Seriously, sometimes there's some confusion out there, but mostly people seem to get us straight. It's a great group of companies, and I'm proud to be one of the oaks. The next column, in Barron's of June 15th, is the Streetwise column written by Jack Huff. Why the enormous IPOs won't sink the stock market. Will trillicorns break the stock market? I'll come to that, but let me start with how we got here, linguistically and financially. Wall Street loves an ugly portmanteau, or jamming together of 2 words in a way that sows confusion, followed closely by dislike. Until recently, its crowning achievement were shrinkflation, where companies subtly reduce product sizes to raise unit prices, and garbitrage, when a takeover announcement sends shares of low-quality companies in the same industry higher. Then along came Space Exploration Technologies, or SpaceX. Back in a 2013 article, a venture capitalist named Aileen Lee came up with a term for private companies valued over $1 billion. She called them unicorns, to denote their exceptional rareness. She found just 39 U.S.-based ones. Today there are more than 800, roughly the population of Tapanuli orangutans, or wild Bactrian camels, but it's too late to change metaphors. Even more striking than the population growth of unicorns has been their swelling sizes, which has set off a portmanteavalanche of hideous new classifications. Today there are decacorns valued at over $10 billion, such as artificial intelligence search engine Perplexity and Fortnite maker Epic Games. There are hectacorns worth over $100 billion, like financial technology company Stripe, TikTok owner ByteDance, and Databricks, a platform for organizing data for AI applications. And there are trillicorns, still, probably. SpaceX was a trillicorn, but it went public on Friday at a deal price that valued the company at over $1.7 trillion. So it's now out of the unicorn herd altogether, since unicorns are private. There are still some high hectacorns and maybe even trillicorns. Private companies are valued infrequently during funding events, so we can only extrapolate their current values. OpenAI, creator of ChatGPT, was valued at $852 billion in a March funding round and over $1 trillion in some private share transactions. Anthropic, owner of the Claude AI model and coding tool, was valued at $965 billion during a May fundraising. OpenAI and Anthropic have filed confidential paperwork to go public and could begin trading later this year. More AI companies are expected to follow soon, since the infrastructure they're building is extraordinarily expensive, and the stock market offers a key funding advantage. Long public companies can tap the market for more money too. Alphabet's raising $90 billion for AI in a stock offering. This is a potential stock market sea change. For the past 23 years, the supply of shares has been shrinking. Companies have brought back gobs of stock while turning stingy on dividends. They like that buybacks don't require an ongoing commitment. Fewer companies have gone public and more have been taken private, resulting in thousands fewer listed companies since the mid-1990s. To the extent that falling supply leads to higher prices, a shrinking U.S. stock market might have juiced investor returns for decades. But this year's parade of plus-size IPOs could increase stock market supply. Should investors be worried? No, for 3.5 reasons. Also, maybe a little for one reason. Past stock issuance waves have coincided with handsome returns. Deutsche Bank has studied the matter and found that returns averaged 8% in the first 3 months of IPO sprees and 20% in the first 12 months. A notable exception was the global financial crisis of 2008 and 2009, when some companies sold stock out of desperation. But in general, strong stock markets beget IPO booms, and cycles can be long-lasting. Also, it's a big stock market in terms of value, if not listings. The Wilshire 5000 Total Market Index, which these days, due to shrinking supply, tracks just over 3,400 stocks, has a market value of about $74 trillion. It can absorb a trillicorn or two. Deutsche Bank uses a supply and demand model for stocks covering issuance, buybacks, and fund flows. And it says that the largest IPOs in isolation could drag the market lower by 1%, but investors are unlikely to notice, because declines of 3% tend to occur every month or two. A third reason not to panic is that while this will surely be a record year for IPOs, buybacks have been hitting record levels too, which helps offset new stock supply. A half reason is that newly traded stocks won't hit index funds all at once. SpaceX actually sold less than 5% of itself to the public. This float of shares available for trading is what most indexes track, not total market value. This one is only half a reason, because some indexes have scrambled to change their rules for SpaceX and its tiny float. Both the NASDAQ 100 and Russell 1000 recently loosened float requirements and fast-tracked inclusion timing. The S&P 500 index is sticking with its rules, and SpaceX falls short of inclusion on 3 counts. It hasn't been trading for at least a year, it doesn't have at least a 10% float, and it isn't profitable. Put it all together, and the march of trillicorn IPOs doesn't portend doom for investors. But it's worth keeping an eye on. The stock market already trades at an ambitious 22 times this year's projected earnings, and bonds offer competition. 10-year treasuries pay 4.5%, up from 1.5% 5 years ago. Newly public companies typically have lock-up periods that prevent insiders from dumping shares for a while, often 6 months or so. Eventually, lockups expire, and float increases, along with index fund exposure. That's fine, unless shares are outrageously expensive to begin with. SpaceX trading will likely be volatile in early days, but suppose the share price gets up to $175, up about 30% from the offering price. There are 12.7 billion total shares outstanding. Revenue this year is estimated at $34.5 billion. Those numbers make for a price-to-sales ratio of 64, compared with 3.3 for the S&P 500. SpaceX growth projections are otherworldly, but those can be subject to revision. 3 years ago, the consensus estimate for Tesla's 2025 revenue was $163 billion. The actual number was $94.8 billion. Then again, investors don't seem to mind too much. Tesla shares are up 59% in 3 years, only 18 points behind the S&P 500. With a look back at what happened last week and a look forward to what happens this week, we have the review and preview section in Barron's of June 15th. It starts with investors are giddy, but don't panic. Iran, inflation, the prospect of a Federal Reserve rate hike. Despite these risks, the S&P 500 is up more than 6% this year. That suggests some complacency. You can see this in a weekly gauge of sentiment officially known as the Levkovich Index. Citigroup named the model in 2021 to honor the bank's late chief U.S. equity strategist Tobias Levkovich. A year ago, the index, which measures margin debt, trading volume, short interest, and 6 other factors, had a reading of 0.19. Anything above 0.38 is euphoria, and below negative 0.17 is panic. It's now showing signs of giddiness. On June 5th, it hit 0.93, its highest since the post-COVID rally of 2021, says Scott Kronert, Citi's head of U.S. equity strategy. Barron's often displays the index on the Market View page. When the index has been this high in the past, the median decline for the S&P 500 over the next 12 months is 13%. Still, notes Kronert, stocks can exist in euphoric conditions until they have a concrete reason to fall. That makes timing very tricky. In fact, Citi expects stocks to forge ahead, recently raising its S&P 500 forecast to 8,100 by year-end, up from 7,700. The main reason? Earnings growth should remain strong. Kronert says largely driven by an artificial intelligence spending supercycle that's still in its middle stages. Don't be surprised if the party lasts a while longer. That was authored by Paul R. LaMonica. Last week, in the markets, stocks globally sank after the NASDAQ sell-off on Friday. Iran and Israel traded airstrikes. Volatility hit stocks. President Donald Trump warned the Federal Reserve not to raise rates. Stocks rallied on Tuesday, then fell as the tech rally faded, and after the U.S. exchanged strikes with Iran over a downed helicopter. May inflation came in at 4.2%, the hottest in 3 years. The European Central Bank broke the ice by raising rates. Stocks snapped back on Thursday on hopes for an Iran deal and rode the SpaceX initial public offering on Friday. On the week, the Dow rose 0.7%, the S&P 500 0.7%, and yes, the Nasdaq Composite 0.7%. In companies last week, Meta Platforms said reports of a big stock sale are pure speculation. Apple introduced an AI-enabled Siri at its developer conference, CEO Tim Cook's last conference. Marvell Technology and Flex will join the S&P 500. Pool and Campbell's will drop off. New World screwworm cases in U.S. cattle rose to 9. The U.S. added Alibaba, Baidu, BYD, and NIO to its list of companies it says are helping China's military. Oracle said it expects $70 billion in net cash outlays for data centers in fiscal 2027. In deals, the Justice Department approved the $81 billion Paramount Skydance buy of Warner Brothers Discovery. SpaceX sold 556 million shares for $135 each, raising $75 billion. On its Friday debut, the stock rose 19%. OpenAI filed for its IPO. Italy's Intesa Sanpaolo offered $35 billion for Banca Monte dei Paschi di Siena. And this week, on Tuesday, June 16th, the Census Bureau reports residential construction data for May. Economists forecast a seasonally adjusted annual rate of 1.43 million privately owned housing starts, slightly less than in April. Wednesday, June 17th, the Census Bureau reports retail and food service sales for May. Consensus estimate is for a 0.5% month-over-month increase, matching the equity and fixed income markets are closed in observance of Juneteenth, National Independence Day. April, the Federal Open Market Committee announces its monetary policy decision. The central bank is widely expected to leave the federal funds rate unchanged at 3.5% to 3.75%. The FOMC members will also release their summary of economic projections. The last SEP from March showed a median projection of 1/4 point interest rate cut by the end of this year. Traders are currently pricing in 1/4 point rate hike by year end. This will be the first FOMC meeting as Fed chair for Kevin Warsh, who succeeded Jerome Powell last month. Moving on to the previews section, what's happening this week? On Tuesday, June 16th, the Census Bureau reports residential construction data for May. Economists forecast a seasonally adjusted annual rate of 1.43 million privately owned housing starts, slightly less than in April. On Wednesday, June 17th, the Census Bureau reports retail and food service sales for May. Consensus estimate is for a 0.5% month-over-month increase, matching the April data. Excluding autos and gas, retail sales are expected to rise 0.3%, 0.2 percentage point less than previously. The Federal Open Market Committee announces its monetary policy decision. The central bank's widely expected to leave the federal funds rate unchanged at 3.5% to 3.75%. The FOMC members will also release their summary of economic projections. The last SEP from March showed a median projection of a 1/4 point interest rate cut by the end of this year. Traders are currently pricing in 1/4 point rate hike by year end. This will be the first FOMC meeting as Fed chair for Kevin Warsh, who succeeded Jerome Powell last month. On Friday, June 19th, equity and fixed income markets are closed in observance of Juneteenth, National Independence Day. By the numbers, 10 million. That's the cap on Switzerland's population until 2050 if a Sunday referendum passes. The population today, 9.1 million. $807 billion. That's the amount of the most illiquid credit assets held by U.S. life insurers, 20% of their 2025 fixed income portfolio. 53%, the percentage of U.S. families in a Reuters Ipsos poll who fear a household member could lose their job to AI. And 35 million, the estimated number of people who migrated globally in 2023, up from 13 million a year in 2000. On to the articles. Restaurant stocks look appetizing. It's tough being in the dining out business right now. Soaring food costs are keeping families at home. Still, these stocks represent different ways to invest in a potential turnaround in the restaurant business, by Evie Liu. The restaurant industry is facing one of its toughest operating environments in years. Traffic growth remains sluggish across much of the sector as consumers become selective about their spending. The expense of eating out far outpaced grocery price hikes in recent years, making the value gap hard to ignore. Meanwhile, higher labor and food expenses continue to pressure margins, leaving operators little room for error. Investors have noticed. Many restaurant stocks have been marked down sharply as Wall Street grows less willing to pay premium valuations for companies with uncertain same-store sales growth and squeezed profits, even as they open new stores and enter new markets. Yet, periods of uncertainty often create opportunities. Some restaurant operators are still delivering healthy traffic growth or taking market share from weaker competitors. Others have credible turnaround plans or durable brand strength that investors may undervalue. Some have seen their shares punished so severely that expectations now appear low relative to their long-term prospects. Now might be a good time for another look as the stock market approaches a potential shift away from momentum trades. After a long run led by high growth, high valuation stocks, especially names linked to technology and artificial intelligence, investors question whether too much optimism is crowded into too few winners. The S&P 500 index took a notable dive on June 5th, led by some of the most expensive stocks. That could open the door for a rotation toward those with steadier cash flows, reasonable valuations, recognizable brands, and clear paths to margin recovery. Restaurants aren't an obvious haven. It's still a consumer cyclical industry. But some beaten-down names could benefit if investors look beyond the most chased-after trades. Barron's picked 6 stocks that represent different ways to play a potential restaurant rebound. The first, Brinker International. Its recent price is $150.83. Its market value is $6.5 billion. Its forward price-to-earnings ratio is 12.7, and the 52-week return is a negative 14.9%. Chili's has become one of the industry's most closely watched comeback stories, yet its parent, Brinker International, still trades at a valuation that leaves room for investors to take another look. Investors treat Chili's like an aging casual dining chain, but the brand has regained cultural relevance with simpler operations, sharper marketing, and new menu items to attract younger consumers. Wall Street expects 2026 earnings to increase 21%, with an average stock price target 18% higher than recent levels. The next company is Dutch Brothers. Recent price, $57.79. The market value, $10.1 billion. The forward price-to-earnings ratio, 58.7. And the 52-week return, a negative 21.2%. Dutch Brothers is a rare growth story. In the first quarter, net revenue rose more than 30% from a year ago, driven by 8.3% growth in same-shop sales and more than 150 new stores over the past 4 quarters. Trading at 59 times forward earnings, the stock isn't cheap. Investors are paying up for what Dutch Brothers might become, a national drive-through beverage chain with a loyal younger customer base and a long runway for new shops. Wall Street estimates that earnings will increase 20% in 2026 and 33% in 2027. Next is Yummy Brands or Yumi Brands or Yum Brands. Yum / on the New York Stock Exchange. The recent price, $151.63. Its market value, $41.8 billion. The forward price-to-earnings ratio, 22.1. And the 52-week return has been 8%. Shares of Yum Brands have been largely flat this year, even as the company delivered 15% revenue and adjusted earnings growth in the first quarter. Taco Bell and KFC are well positioned as consumers across the globe seek affordable options amid economic pressures. Pizza Hut is the company's weak spot, and Yum has been exploring a potential sale. While a divestiture could hurt earnings initially, it would allow management to focus on its faster-growing businesses, which could drive up Yum's stock valuation. Domino's Pizza trades as DPZ. Recent price, $317.69 a share. Market value, $10.6 billion. The forward price-to-earnings ratio, 16.1. The 52-week return, a negative 31%. For investors wanting a quality name trading at a discount, Domino's Pizza might be a good option. Domino's has the bones of a great restaurant business, a franchised model, strong advertising, powerful supply chain, and a brand built around value and convenience. Wall Street expects total revenue to increase 5.6% for the year and earnings to increase 9%. Analysts polled by FactSet have a consensus target price of $407, suggesting 26% upside. Chipotle Mexican Grill is next, trades as CMG on the New York Stock Exchange. Its recent price, $29.88. Its market value is $38.3 billion. Its forward price-to-earnings ratio is 25. Its 52-week return, negative 41.6%. Chipotle Mexican Grill has fallen out of favor over the past year as concerns emerged about the company's ability to maintain its industry-leading growth. Total revenue rose 7.4% in the first quarter, but comparable sales increased just 0.5%. Margins also moved in the wrong direction, hurt by rising labor and beef costs. If foot traffic trends stabilize and margins hold up, investors could reward the stock. Earnings are expected to stay under pressure this year, but rebound 19% in 2027. And finally, the number 6 restaurant stock that looks appetizing, Shake Shack, trades as SHAK on the New York Stock Exchange. Its recent price, $53.78. Market value, $2.3 billion. The forward price-to-earnings ratio is 43.6, and the 52-week return, a negative 57.5%. Shake Shack is a risky bet. It could have the most upside if everything goes right, but it also has the most to prove. The stock has lost 44% since May 6th, after the company reported an operating loss for the first quarter. The burger chain is particularly vulnerable to the surge in beef prices. A successful margin recovery would probably bring investors back, since top-line growth remains healthy. Wall Street expects shares to reach $84, about 45% higher than current levels. So there are half a dozen stocks that you can evaluate and see if you're interested in. The next article, the great, big, boring SpaceX IPO. SpaceX will have to show growth that exceeds estimates to keep the stock in orbit, by Al Rote. The SpaceX initial public offering was expected to deliver exciting twists and turns, fireworks and flare-ups, the kind of drama usually reserved for a summer thriller. Instead, it proved to be something far more disappointing, rather ordinary. The public debut of SpaceX, officially Space Exploration Technologies, portended different things to different investors, but was significant for all. To some, it was an example of terrible corporate governance and a sign of irrational market exuberance. To others, it represented a gateway to an artificial intelligence-fueled utopia, in which SpaceX is worth trillions. And for others, it represented the dream of an American manufacturing renaissance paired with cutting-edge AI. It'll take time to settle the bull-bear debates. By most measures, SpaceX's IPO was a success. Trading went off without a hitch. The stock gained 19% from its offering price of $135 to finish the day at $160.95. There was lots of it, too, with a whopping 500 million plus shares changing hands. But SpaceX, which beat OpenAI and Anthropic to be the first AI company to go public, couldn't answer the one big question that investors have been asking. Is AI a bubble? It's hard to overstate the hype entering Friday. SpaceX pioneered reusable rockets and built Starlink, a space-based broadband service poised to revolutionize mobile connectivity. The lead-up to its IPO became a cultural event, with a reach extending well beyond the stock market. On Wednesday, there were almost twice as many searches for SpaceX IPO as for Iran war, despite the U.S. military striking new Iranian targets. The hype also took its toll on other space-related stocks, which ran up into the IPO, then fell off a cliff on Friday. Shares of launch services provider Rocket Lab closed down 10.8%, while AST Space Mobile, which is building a communications satellite constellation, fell 15.5%. Other space stocks, such as Firefly Aerospace, Intuitive Machines, Voyager Technologies, and Redwire, dropped 11 to 19%. In the end, though, SpaceX's debut was relatively mundane. Shares opened at $150 and never looked back, trading as high as $176.52 before resting near $165 for much of the day. It made for an orderly one-day post-IPO rise. A 10 to 30% pop for a large tech IPO is normal and shows that the deal was priced well and the market was ready to accept the terms offered. Major brokerage firms, with the exception of Robinhood Markets, which experienced technical issues due to high traffic, said the day went as planned. By the session's close, SpaceX was valued at $2.1 trillion, roughly 60 times estimated 2026 sales of $35 billion and 33 times estimated 2027 sales of $64 billion, according to FactSet. The valuation is also 210 times SpaceX's estimated 2026 earnings before interest, taxes, depreciation, and amortization, known as EBITDA, of $10 billion and 91 times estimated 2027 EBITDA of $23 billion. SpaceX will have to show growth that exceeds estimates to keep the stock in orbit. Eventually, it plans to put AI data centers in space, leveraging its low launch costs to gain an advantage over Earth-bound data centers. Lower costs are dependent on SpaceX's huge, fully reusable Starship rocket system. That isn't fully operational yet. Because Starship enables better Starlink and AI computing, getting that spaceship consistently into orbit and operating properly will be a key catalyst for shares. Wall Street has its opinions. In the immediate days before the IPO, SpaceX got its first buy rating and $190 price target. Soon after its debut, SpaceX earned its first sell rating, from CFRA Research, which put a $115 target on the stock. The analyst cited the company's growth plan, which was described as ambitious but risky, and the share's high valuation. By day's end, the average analyst price target sat near $174. That's from only 5 analysts. There'll be closer to 50 covering the stock in a matter of weeks. None of that matters all that much to the big winners of Friday's trading, the 20-plus bankers involved in the IPO. They might not get a pat on the back from everyday Americans, but the pricing and trading of something as complicated as SpaceX was nothing short of impressive. The IPO of Facebook, now Meta Platforms, another highly anticipated event with a celebrity CEO, didn't go nearly as well. Trading was challenged, and the stock spent most of the day trying to stay above the $38 IPO price. The SpaceX bankers were rewarded with $500 million in fee income for their job well done. The IPO will probably also get a big boost to Republican politicians, given how wealthy some of the party's top donors, such as Peter Thiel and Antonio Gracias, just became. The biggest beneficiary of the IPO, of course, is CEO Elon Musk himself. His ownership stake has made him the world's first trillionaire. Whether the investors who bought the IPO do as well remains to be seen. Now that initial trading is over, SpaceX needs to show that despite the mundanity of its debut, it can deliver a science fiction-like future. Anything else would be a big disappointment. The next article, in Barron's of June 15th. How community became the hottest word in banking. Regulators, lawmakers, and consumer groups are debating what it means to be a community bank. It has implications for lenders and borrowers, by Rebecca Ungarino. The Walton State Bank has served 200-person Walton, Kansas since 1907, when the state granted Guy Hawk a charter to start a local bank. Some 45 original stockholders invested alongside Hawk, a sewing machine salesman. Today, the bank's lone branch sits on Walton's main street and has $12.5 million in assets. It specializes in loans for purchasing farmland and cattle. It's a community bank, in spirit and statute, small asset base, local client relationships, and straightforward financial services. Origin Bank, based in northern Louisiana, has also been considered a community bank since its founding in 1912. With 60 locations in 5 states today, it bears little resemblance to Walton. Origin drew scrutiny last fall after disclosing loans it made to the bankrupt subprime auto lender Tricolor Holdings, whose CEO sat on Origin's board and saddled a web of banks with losses. As community banks, Origin and Walton are subject to less rigorous monitoring and oversight than their largest counterparts like J.P. Morgan Chase and Bank of America, or big regional lenders like Citizens Financial Group and Zions Bancorp. The Federal Reserve's definition of community bank, those with up to $10 billion of assets, covers roughly 96% of America's federally insured lenders. Industry groups and key regulators now say that's not broad enough. In fact, the definition of community is turning into one of the primary financial regulatory debates of President Donald Trump's second term. In recent months, the Office of the Comptroller of the Currency, or OCC, and the Federal Deposit Insurance Corp have raised the threshold for community banks to $30 billion when it comes to essential regulatory functions like merger applications and regulatory exams. Under a $30 billion framework, all but 70 or so of the nation's 4,276 lenders would be considered community banks. That's a necessary corrective, according to some Republicans. Dodd-Frank sought to end too big to fail, but in fact it created a regulatory environment in which community banks are too small to succeed. said Senator Bill Hagerty, Republican from Tennessee, during a Senate Banking Committee hearing in February. For smaller banks, the result has been a bloodbath. The U.S. has lost 3,600 community banks since 2010. Community groups and some Democrats say that relaxing community definitions could have unintended consequences, including losing the benefits of community-focused lending. Community banks play a critical role in supporting local economic growth through relationship-based lending, local decision-making, and a strong commitment to the communities they serve, says Rebecca Romero Rainey, CEO of the Independent Community Bankers of America, or ICBA. That's what defines community banking, a focus on accountability, local engagement, and meeting the needs of customers. The National Community Reinvestment Coalition, or NCRC, an economic justice advocacy group that negotiates community benefits agreements between banks and community groups, says the OCC's plan undermines the 1977 Community Reinvestment Act, which requires banks to serve their local communities, including low and moderate income neighborhoods. If agencies conduct cursory reviews of these applications, they're likely to fall in their requirements to ensure that banks confer public benefits, wrote Jesse Van Tol, CEO of the NCRC, in a letter to the OCC in January. The higher cap rule went into effect in April. Under the $30 billion cap, more consumers are likely to bank with firms whose loan book quality is less scrutinized than it once was, or that are required to hold less capital on their balance sheets. I think it's fair to say that $30 billion banks aren't really community banks. At least a lot of them could be multi-state complex operations, says David Zaring, a professor of legal studies and business ethics at the Wharton School of the University of Pennsylvania. Larger banks, meanwhile, could face competition from smaller banks if they can afford to allocate money away from regulatory compliance costs and toward more services. The debate played out over the definition of community is part of the government's most significant bank regulation overhaul since the 2008-2009 financial crisis. Democrats, including Senator Elizabeth Warren of Massachusetts and Representative Maxine Waters of California, are pushing back on regulators' efforts, saying that Trump-appointed officials are angling for less oversight under the cover of helping local communities. Policies are disfavoring the safest institutions that provide the most support to the Main Street economy, community banks, by massively and unfairly favoring the riskiest institutions, big banks, crypto banks, and fintech firms, said Philip Basil, Director of Economic Growth and Financial Stability at Better Markets and a former financial institution policy specialist at the Fed. Truist securities analyst Brian Foran says the term community banking has lost some meaning in the digital banking era. Consider financial technology firm Chime, which offers banking products through two lenders that fit the regulatory definition of community banks, each with under $10 billion of assets. Chime opened 13% of all checking accounts in the U.S. last year, Foran noted. That's a big community. The NCRC calls out the need for local branches even in a digital world. The presence of branches is critical for traditionally underserved communities, so they're not forced to rely upon expensive payday lenders or check cashers, the group wrote in its recent letter. Such branches could get less attention under new community standards, it added. Bank lobbies recognize that their position in Washington, D.C. may never be stronger, and they're pushing for as much change as possible before the next wave of elections. Still, there are limits to what regulators can pass on their own. The Fed probably wouldn't raise its $10 billion limit, in part because it would require an act of Congress, says Raymond James analyst Daniel Tomeo. It can, however, adjust how it oversees small to mid-sized banks through rule tailoring without congressional approval, Tomeo says, and we think this is increasingly likely. He says the move could save banks several $1 million a year in compliance costs as they cross the $10 billion asset threshold. At the Fed, bank lobbyists pushing for lighter small bank regulation have won an influential ally. Vice Chair for Supervision Michelle Bowman, the Fed's top bank regulator, for whom community banking is personal. Her family's been in the business since 1882, when her great-great-grandfather helped form Farmers and Drovers Bank in Kansas. She worked there from 2010 to 2017. My most challenging role was as compliance officer, working with our small team to implement many of the new post-crisis regulations, she said in 2018. Although the crisis revealed weaknesses in the U.S. financial system that needed to be addressed, I've witnessed firsthand how the regulatory environment created in the aftermath of the crisis has disadvantaged community banks. Bowman favors increasing static and outdated asset thresholds on small lenders. Meanwhile, community banks are aiming to protect their domain. In a new advertising campaign, the Independent Community Bankers of America attacks credit unions for undermining their mission while avoiding federal taxes. Big credit unions have perfected their act. While presenting themselves as community champions, they quietly make accountability, tax fairness, and consumer choice disappear. In response, the credit unions accused the ICBA of hypocrisy and touted their own community status. Let's be honest about what this really is, Jason Stverak, Chief Advocacy Officer with the Defense Credit Union Council, said at the time. A well-funded attempt by the banking lobby to distract policymakers from its own preferential tax treatment while attacking the cooperative financial institutions that millions of Americans trust. And with that, we've come to the end of our reading of Barron's Magazine for the issue date of June 15th. This is your reader, Eric, saying be well, be safe, look after each other. Remember our veterans, especially those we've lost recently. Bye for now.